Hi, everybody. I'm Debbie Faulkner with Burke Faulkner Law, and welcome to our next webinar, From Panic to Pandemic. I'm here to introduce Brandon Shepler. I am, as you probably know, I'm the owner of Burke Faulkner Law here in Oldsmar, and a lot of my clients and friends and business owning clients have asked me a lot of questions about the marketplace. We all know the markets are going crazy. They're going up, they're going down, they're tanking. A lot of people are saying, what retirement? I don't need estate planning. I don't have a retirement to plan for anymore. And that's why I asked my friend Brandon. Brandon and I have known each other since high school. We were in the same history class, and then we took very divergent paths, me in the legal field and Brandon in the finance world. And Brandon holds a lot of financial designations, the most important of those being a chartered financial analyst. A chartered financial analyst is the highest credibility that you can have. It's a legal and regulatory recognition in the finance world. It's the highest designation that you can have. It's internationally recognized, and very few people in the private sector have this designation. And he also is a CFP, a financial planner, and he's a chartered investment management analyst, a CIMA as well. So Brandon has a high amount of expertise in understanding the markets and what they're doing. And he's here to give you information about what the market's doing and talk about some trends that are going on in this world so we can have a better understanding of how to maximize our return on investment in a recession.
And there are underlying issues beyond that as to why I think the sell-off has been as quick and as large as it has been. But it's worth noting that, the sell-off that we saw is the fastest bear market in history. It took 22 days for the market to fall 20%, outpacing the Great Depression or the recession we saw in 2007, 2009. And I'll slow down, don't worry. So the recession that, we last, witnessed from 2007, 2009 was considered the Great Recession. It was a financial, crisis that affected the globe. And people are now calling, for this, pandemic to cause disruption, the likes of which we've never seen, quoting certain outlets. And I would really argue that the last recession was a bigger issue than this will turn out to be. This will have shocks to the system that we'll address and deal with, but it's not going to lead to a protracted recession that takes 5 or 6 years to recover losses. That's the first point worth noting. Second is that given the speed of the sell-off, we do expect a fairly quick recovery. It's just going to lead to several industries doing better than others and several industries doing worse than others. And that's not unique to any recession. Every recession has its winners and its losers. It has the parts of the economy that are hit harder than others, and it does impact different demographics differently. So the first step here is to address that we are in a recession. I don't think the data will disagree with that. In 2 quarters, we had 3 million layoffs or unemployment numbers coming yesterday. It's the largest single unemployment number ever seen in the United States, and that alone should probably warrant further investigation as to how long unemployment will remain that elevated and the impact it'll have on GDP growth. Now, going back to this current environment, the United States has recently passed China and Spain in terms of reported cases of the coronavirus, and that's a matter of obviously testing as well. I wouldn't suggest that we have more cases in other countries at this point in time, and really we're just testing at a higher rate finally. And we do have a population that skews the data in favor of higher amounts of infection. I guess we have a question?
Yes.
All right.
So it should be on the screen now?
Where is it?
Says, is the 2 trillion prescription worse than the illness?
The answer that I would go with is yes. So the question is referencing the $2 trillion stimulus package. I would argue that it's going to probably cripple our ability to issue debt domestically more so than the virus would cripple us if handled slightly differently. And obviously this is a unique pandemic. We don't really have a way to handle this, on paper. It's an outbreak that most countries are treating as a one-size-fits-all approach that it really is not such. The disease itself is age-based, and we're not really admitting that, but it does have a much higher death rate for older individuals, which is why countries like China, who have 6% of the population over the age of 70, are faring better than Spain or Italy, who have 17% of the population over the age of 70. So I think the stimulus package that we're using, it's a shot in the arm, but it's not necessarily a shot in the arm in the right places. So I think that's the other issue here, is that we might need additional stimulus to correct market decline, and that could lead to a further issue down the road for U.S. deficit to GDP ratios. So that's question 1. All right. And kind of continuing, the last recession that we had, you did see, financials and real estate as the two catalysts and I would argue causes for the last crisis. And because of that, those two sectors fared very poorly for the decade that followed the last recession. During this pandemic, I would argue the same, that you're going to see restaurant companies come out of this very slowly and recover very slowly. Cruise lines, airlines, Uber, they're going to need to receive some bailout money, but they're probably also going to recover quickly and then elongated, meaning that they're not going to recover all their losses anytime soon, because again, these industries will cripple for years. People won't travel as much. So what I'm suggesting everyone do here is not panic. It's that if you look at prior recessions and view history, as not uniform, essentially, every recession has different triggers, similar outcomes, and then different recovery stories. And I think our recovery story here will be focused on companies that have really low debt, companies that operate with less of a workforce, so all these technology companies, and companies that will benefit from a push to online, whether it's online shopping or online business meetings or online communication. So I still think that is essentially where you can sell something and see the losses on paper. And then a lot of times people do that, panic, go to cash, and never re-enter. Some people never sell and just ride it out. And that's where I kind of put together this slide called the three approaches to handling a recession. And pretty much what I'm articulating is that you can do nothing and you'll be fine in a couple of years. You can panic and go to cash and you're going to honestly see a pretty subdued rate of return for the next decade. Or you can take a more educated approach to this and view the economy as different pieces and figure out where to invest capital and reinvest capital. That way, the recovery is not painful and elongated for you as well as an investor. And one other side comment here is if anyone wants to subscribe to these, to this channel, I would really appreciate that. We do these weekly for certain topics, and I would like to do another one of these in the future if anyone wants. But that's definitely something to consider. So going back to the recession, though, that we're going to face, the stimulus package will help the average American weather at least a month or two of this, I would argue. But that's where we do need to figure out how to correct the current, shutdown of the economy, as we call it, quicker than I think most have a plan to do so. And if we stay shut down for 2 months, 3 months, stimulus of $2 trillion will not be enough money to really keep majority of business owners with doors open. And that's the next shoe to drop, I would argue, is that you're going to see employment spike, which we already saw. Then you will see small businesses start to shut their doors, which will happen at an accelerated rate. And from there, Congress doesn't really have, and the Fed doesn't have a tool to help small business owners directly. We saw that in 2008. The tools that we have help, big businesses because they're easy to stimulate the economy with. You can easily give Delta money, stop furloughing employees. Delta's financials are public record. They can see where the money's going. Joe's Pizza does not have public record in the financials. So we're not able to help these smaller businesses out directly or in the same way that we can help large corporations. And it's much more, it's a minutiae approach if you take that route. So that's where we're going to continue to struggle to help small businesses through stimulus. It can't be done in the same fashion. And, on that note, that's where I would argue again that you look at parts of the economy that are, and I hate to say this, but that favor big business for the time being, because that is where investment returns will probably be better and will correct more quickly. If you're looking at small cap companies in the United States, I would argue that they're probably going to see fairly low returns compared to your large cap technology companies for the next 3 to 5 years. And then I did print some numbers off to go over, but so pretty much what I want to also bring up here was the fact that the United States has 10% of our population over the age of 70, and Spain is 17% of the population. Italy is 18. Korea is 6 and China is 6. So if you've noticed the path to recovery, China reported their first outbreak in January. No one took it seriously. The markets didn't even react. And there wasn't until a divergence in reported numbers in February that the market started taking notice of the fact this could lead to global disruption. So it was an interesting kind of chart where if you look at the charting, and I can send this out to anyone that requests it, China's cases ballooned and then flatlined by mid-February. The global cases started to skyrocket from there. And at that point in time, the market did start to tank. So if we look at where China is today, China has actually recovered pretty quickly. They're reporting less than 100 new cases a day. And that's something that we should take note to as well, is that these countries can figure it out quickly. It's just a matter of how the United States deals with it compared to a country of China, which has half the elderly population. Then I have a question on the screen. It says, I've asked my financial advisor, what changes should I make? And he said, you don't do anything now. Do you agree? I would depending on the portfolio, and I can't really give specific advice, my answer would be most likely I disagree. During every recession, again, there will be winners and losers. Now, most people, when they think do something, they think panic and go to cash, which brings me back to that first kind of slide there. So I wouldn't suggest doing that. What I would suggest doing, though, is looking at what bonds you own. Make sure there's not a continued blowout from NAV, meaning that your bonds are worth less money right now because no one will buy them from you than they should be. There are bond funds right now that are experiencing very large drawdowns compared to what they should be experiencing. Same thing with financials and energy companies right now. Financials will not be in a favorable spot. Interest rates are not going to allow them to make much on net interest income, so they're not going to have large revenue increases for the next couple of years. So financials are another area that if you own direct exposure to, I look at trimming. Energy is another one as well. Energy companies will suffer from this either way. People are not traveling right now. We're staying at home. So obviously oil demand is down. On top of oil demand being down, we've now increased production because of Russia and Saudi Arabia having a little bit of a backdoor disagreement. So energy companies are another area that we think will have long-term pain. So I think the answer to do nothing is not appropriate. It's a matter of evaluating your current portfolio and making sure that the parts that make it up or that constitute your asset allocation are still consistent with the current worldview. The world is definitely different today than it was 3 months ago. I think that's the key point, is that everyone needs to acknowledge that. You can't just put your heads in the sand and try and claim the world is the same today as it was before this happened. So if that answers that question there. But then I go back to rates of return, even for the recession. That's another thing that was always fun to look at. So in the last recession, for instance, energy actually did outperform most sectors early on and then failed to perform well at all for the next decade. Real estate actually held up better than technology for the first 9 months of the recession and then failed to outperform after the fact. So another question on the screen, and it is, what sector do you feel has the most promise for returns? Travel services. So I think in the short term, you might see a quick snapback in the travel stocks. So I think Norwegian Cruise Lines is a good example, or MGM or United Airlines. Those three companies experienced a drop in share price by about 80% from the peak. And they've had a quick recovery in the last 3 days that I think is a little hasty, but they're recovering some of those losses right now. I don't see them returning to their prior, highs though anytime soon. So I think, yeah, you might have short-term outperformance in travel or travel services, but longer term, they're going to take much longer to get back to their all-time highs. I think a better area to look at would be cybersecurity or online business services companies like Slack. Zoom Video has been in the headlines. I'd probably stay away from Zoom Video for right now, though. LogMeIn. Those are all companies that are in the noise of CNBC, for instance. And then regarding my bonds, I'm very conservative because I'm 81 and my bond values are dropped. Yeah, so again, going back to bonds, that's another question on the screen. Bond prices have taken a hit, and it's partly because rates have become unpredictable. The Fed cut interest rates to zero to try and help stimulate the economy and make lending cheaper. That should actually drive bond prices up, depending on what part of the curve you're on, but that hasn't happened because people are now liquidating bonds at record pace, and the supply and demand is causing an issue in what we call NAV discounts. So basically, bonds are being sold at a discount to what they should be worth. And that's not something new. That's happened in 2008, where money market funds broke, and people that thought that they were in cash equivalents were actually down 5, 6, 7%. So the Fed has responded to that as well by injecting an unlimited amount of supply into the bond market to try and help close those NAV spreads. So near term, again, bonds are actually appearing to be more risky than they should be. Long term, they should stabilize, but again, you would want to look at the bond portfolio you own, because certain high yield funds or floating rate funds that are within the portfolio might not recover. This is a matter of just longer term issues that these bonds face, but your bond portfolio should be examined because not all bond funds are identical. And again, if you're conservative, to try and say bonds is a very blanket statement. There's high yield, there's floating rate, there's corporate, there's agency backed, there's government, et cetera. So bonds is a very broad universe. And I think that's the other part with being, older looking for income, is you have to understand what the bond portfolio looks like and what the income looks like that you're receiving off these bonds to ensure that you're not taking on more risk than you think. So then recap. So quick recap where we're at, kind of all over the place. This is my first time doing one of these on a crisis type mentality. So what we're trying to do is just evaluate the current economic landscape and how it's being impacted from the coronavirus and other, we kind of say, triggers to what we're seeing as market sell-off. Currently, the market has been down as low as 34%. kind of recap that for everyone here. We do expect that we'll retest those lows, and I do think that you can expect to see a 35 to 37% max drawdown, meaning we've probably gotten pretty close to hitting it, but I don't think we've hit it for the first time, if that makes sense. We see this in a lot of recessions where you have rallies and then additional drops. And another question is on the screen, would annuity be a good bet now? That's, again, a case-by-case question. So annuities do have the ability to create income streams, but depending on what you already own or what you're invested in or where your investments are today in terms of recovery, sell-off, et cetera, I would say that's not a question that can be answered on the screen. We want to probably table that and take that as a side conversation.
Right. And I think that's one of the things. If anybody has questions, Debbie, how are you going to allow people, maybe you want to?
Debbie can recap that part.
No problem. So if you all have any questions or if you want like a full market analysis that Brandon's already written, we invite you to email us. You can email me at debbie@burkefaulknerlaw.com. That's BURKEFAULKNERLAW.com. It's Debbie@burkefaulknerlaw.com. Or ask your questions right here live on the chat if they're not too personal and divulge your personal information. Also, please subscribe to our channel and you'll get updates because we are planning, especially during the social distancing, which I'm not practicing right now, to be on the screen for you. We are going to be doing more and more webinars and market analysis so that we can all stay updated. So there's a question on the screen that says, can I make money in the market right now? And if the answer is yes, how do I go about doing that? Go ahead, Brandon.
Again, time horizon then is the answer to this question. So in proper time frames, the answer would be yes. I would argue that the market over long enough time horizons generates positive returns regardless of what's going on in the world. And given the sell-off we've experienced, this is a kind of a buy low environment, meaning if you have already missed part of the sell-off and you're sitting in cash, then getting in now would be a pretty prudent idea, as long as you have a couple of years to wait for returns to happen. So in a broad standpoint, yes, you can make money in the market right now. There's an old saying that there's a bull market somewhere at all times. There's a bear market somewhere at all times. It's just identifying what the bull market is a little bit tricky because this is not a predictable problem, at least in the short term. So, if ever anybody that has a slightly decent risk tolerance, I would suggest dipping your toes in the water, maybe buying high quality companies that have good growth profiles and low debt. And that's, in the markets at least, that's a quick way to answer that question that yes, you can make money. It's just a matter of holding on through this and not giving up in the middle of it. And then to kind of revisit one other question I was asked about earlier too about, sectors. Going back to that, I would say that the key part to this recovery will be that countries, we need a vaccine, but that's still 18 months out. Countries will also need to start adapting to the fact that this is not going to go away overnight. We can, what they call flatten the curve, which means that the infection rate will lower because we're practicing social distancing, as Debbie said. We're trying to get infections down, but the economy needs to reopen. And for that to happen, we need to actually identify the at-risk populations, make sure that they're being taken care of, make sure hospitals can service them, and let people that should be working work. And until we can really figure out a path to get back there, I do think that there's a high risk that we continue to revisit the lows of the market. Stimulus aside, you are going to see a bigger impact than most analysts are predicting because most revisions have been upwards in terms of how big the sell-off will be or how big unemployment numbers will get, et cetera. So I would, again, go back to the strategy here that, on up days like you saw yesterday and the day before, those are worth noting. They're great days. But I wouldn't suggest that means that we're out of the woods yet. And on days like today where the market's down, I wouldn't all of a sudden panic either and just give up. It's going to take, again, like a very logical, rational approach to investing right now to make sure that you stay invested, but stay invested in the right areas. And if you do want to exit the markets, you have an entry plan. Because most people, their entry plan is I'm going to leave the markets and get back in when the recovery happens. If you follow that approach, you've missed the recovery. That's the problem trying to time something like that. So, when I first went back to the three approaches that were the slide that highlighted this, it was do nothing, which was I called the ostrich approach. That's basically just leaving your portfolio the way that it is, and even in doing so, you still have positive returns over 10 years. The S&P generated a 7% plus return from 2008 to 2018. Then the panic approach, people that left the market in January 1st, 2009, went to cash and then went back in 2011 when the market showed signs of recovery. For individuals that did that, you had a 3% rate of return over 10 years. Obviously not very great. And then for investors that actually decided to sell some of their losers as in financial companies and material companies and real estate companies, they experienced returns that were significantly better than the other two approaches. Their returns over 10 years were greater than 11% annualized. So that's where I think going back to the drawing board here, the worst thing you can do is panic, go to cash, and then revisit this later. The thing most people do is just pretend like nothing's happening and just ignore things, which is also fine. At least you're not panicking. The best thing people can do is really reevaluate their financial position, their needs, what risks this could have for their own job security, their own financial future. Make sure their portfolio is in line with that. Make sure their investments are in line with the path that the economy is on. And I think that's the hardest thing to do for an individual is admit when things are not going to recover, admit when their job might be at risk, and admit that there's changes that need to be made because most people don't have the desire to face the panic or face the loss of the portfolio suffers. So I think as long as you stay, that screen you closed here. There you go. And I think as long as you stay the course, and you don't panic, everything will be fine.
Brandon, I have a question for you. So last week you sent out an analysis report that you did that had a couple of stock picks that you thought might outperform others based on the type of economic situation we are facing. I think you divided it into some sectors, like there were some stocks you thought might do better based on our work at home type of environment, and then some stocks that would be adversely affected by our work at home social distancing mandates. Can you just go into a little bit about how you pick those or how you think that through?
Yeah, so what I did was broke the list into three different areas. One was we call the chronic corona crisis stocks. Those are ones like, airlines, travel companies, hotels that logically have seen share prices just plummet. And that's as a result of having to close, travel. Cruise ships won't operate till at least mid-April now. So there's a real impact to their financial statements that will not be recovered overnight. And that's, logical reason why stock sell-offs occur. What I do find, though, is that several of those companies had sell-offs that were not warranted by the projected revenue loss, meaning that they're oversold. So I think that, going back to the original question about, travel services being an area to invest in, yes, again, in the short term, you could, because I would say that these companies are probably beaten up to the point that the valuations you're seeing are cheap. But again, you have to have a pretty long time horizon, and I would argue risk tolerance to jump into that boat, pun intended. Then if you go to the middle section of that, the kind of companies that put together, it was disruption companies. And disruption is not a new story. It's not a story that will go away. All that means is these are companies that continue to evolve and take market share from existing, call it dinosaur companies that have a lot of overhead, a lot of debt, a lot of employees. So companies like that will continue to outperform, I argue. They'll have large sell-offs in the near term, but they're like nimble ships in a way in the storm. Like they can essentially adapt, reposition, and come out of this stronger, arguably, much like Amazon did in the last recession or Netflix did in the last recession. Those were companies that were hurt, early on, and then managed to recover and outperform ever since by miles. And the other list I put together was what we kind of call the social distancing list. So social distancing stocks were one that, like people would go online and shop, arguably, which we're seeing, or people are being forced to work from home. How do they invest in companies that they're using? So, if you're using remote conferencing or video conferencing or teaming apps, logically, everyone else is as well, if you're employed right now. So those areas of the economy will also show revenue growth over the long term, I would argue. Cybersecurity is another area where the more we're doing online, the more chances there are of companies being hacked. And you're seeing an increase in that right now as well. So cybersecurity is another direct or indirect winner potentially of this sell-off. And then obviously there are vaccine companies out there that are vying to find, a cure for this, arguably. There's 20 companies, give or take, globally that are, in the running. So that's another area that you could look to invest in, but that's more speculative in the sense that it'll be a binary play. If a company wins, the vaccine patent, then, the stock price would be rewarded for it. Companies that fail to do so, that don't have anything else in pipeline, obviously share prices would fall. So if you're going to invest there, I would really make sure that you know what companies you're investing in and know what risks you're taking on the vaccine side. And lastly, this is an evolving story. So what I mean by that is, depending on how we deal with this from a global standpoint and local standpoint, the recession that we're all speaking of now could be quick, it could be U-shaped, and that's what we're projecting right now. But it could become a long recession if handled improperly. So I would also ask people to continue to monitor how their investments are performing and how the world's dealing with this to ensure that you're not caught with your head in the sand for too long. And obviously, if you again, subscribe to this channel. I'd like to do more of these and kind of keep people abreast of the situation, kind of address weekly recaps in terms of where the market is, and at least help people calm down if need be.
Brandon, I've had a lot of people ask because they're very concerned about what's going on. If you can maybe do an update every week about especially during social distancing, but perhaps thereafter, if we have enough interest, would you be willing to come in and do a market analysis on a weekly basis?
Let's take a weekly recap and discuss, obviously things that have changed or where the markets are, and recap where major firms think they're heading. At the very least, I think that's helpful. And right now, this is obviously a time where people need to be talked off the ledge every now and then. So if at the very least this helps accomplish that, I would love to.
Absolutely. And so, Brandon, is there anything that you think would help investors who want to invest short term and make like a quick return? Is that even possible during a recessionary time frame?
I would honestly suggest no. It takes a risk threshold most people don't have to try and do that, and there's no guarantee because this is not predictable. Going back to that statement, the financial crisis was caused by financial issues. So a prescription of financial stimulus cured the last recession. The current one that we're facing is not financial related. Arguably, it's something that we've not really had to deal with before from an economic shock standpoint. So I'm not sure that we really have a clear prescription from a government standpoint on how to fix this, or stimulus standpoint on how to fix this. So to make money logically and easily here would be semi-difficult, I would argue, in a guaranteed state.
Okay, that makes sense. Do you offer any type of individualized analysis if a client or subscriber is interested in just having a second look at what they are investing in?
Yeah, so for right now, what I've been offering through these state-funded accounts that Debbie and I founded, and I'm not really active at this point in time, but she still is. I always offer to do portfolio reviews for anybody that wanted one, just to kind of assess where you are at. And I do them with no solicitation, no cost, meaning we scrub your information off of it. They go through Debbie first. And I just basically give it back to her to give back to you. And yeah, I would still offer those right now, obviously. I think a second set of eyes can't hurt.
That's right, guys. So what he is saying basically is if you're, if you would like a second set of eyes on your portfolio or what you're invested in, I can get that information from you, remove all of your personal identifying information, your name, your address, phone number, and then have that reviewed by Brandon from an independent perspective, so you won't know anything about you. Obviously, that's attorney-client privileged regardless. And then you can have a second set of eyes, just see what and analyze. And I've seen some of these reports, and they're very detailed about perhaps like you are overweighted in one sector that may expose you to a risk that you didn't even think of. Things like that, at least from an attorney side, I don't even know. I wouldn't even think of these things. But Brandon is uniquely situated to be able to analyze portfolios in a way that makes sense, but it makes sense once he disseminates the information and puts it in an easy to read report. So, guys, if you don't mind, we are trying to get more subscribers to the channel just so that you can receive updates and know what's going on. We are going to be doing more webinars, both the legal webinars and financial webinars on this station. So please like us, like our feed, subscribe to our channel. If you'd like any written of Brandon's written reports, or if you want anything else from us, questions answered, specific questions, or an analysis of your portfolio, email me at debbie@burkefaulknerlaw.com. You can go to our website, burkefaulknerlaw.com. That's BURKEFAULKNER law.com. And we'll be happy to get back with you. Thanks, Brandon, for joining us this afternoon. We really appreciate the update. And thanks, guys. We'll see you next time.
Thank you. So